right, good morning. Happy July 6th. I am coming off of a busy July 4th weekend at the beach. I hope everybody had a great one. Before we get started, I want to tell you this is a big episode. I'm going to get straight into the numbers. I'm going to talk about the weekend that I had because it was a little bit wild. I dove straight into Grayton Beach, but we've got a special guest in the what we call the virtual green room. It's a special one because it's not only somebody that's going to add a lot of value to you guys. We've been teasing up cost segregation for some time now, and I've been saying we're going to get an expert on, and we finally have one, and we're going to break that down. But it's a little bit more special because it's somebody that's been watching and viewing the channel now for some time, and they're an active investor on 30A as well. So not only are you getting an expert, but you're getting somebody that watches just like you, and they're actually doing it in place on 30A. So it doesn't get any better than that. So I can't wait to get Phillip on here in a second to dive into that. But yes, I was just actually explaining to Phillip, I took on Grayton Beach on the 4th, parade, 8:30, stayed out there as long as I could. Man, it was incredible. We've got some video. We're going to make a reel later this week and share it with everyone. But Grayton Beach is as advertised. We've kind of done it before. We took the kids, had plenty of friends, had some friends with the parking passes down there, grilling on the beach. It was spectacular and really what the area is all about. So I was grateful to get a piece of it. And but man, it was busy down here on the beach. But let's get into the numbers so that we can get to Phillip. So here we go. New listings 39 on the new listings. So listen, that's a little lower than what we've seen. You know, I love that. We've been in that mid to high 40s, which is kind of where we're settling in. I really don't know how much. Again, this is like 72 hours starting on Friday, which would have been the 3rd, okay? Kind of taking us through. So this is going to be a little lighter, but let's look at the pending sales. Pending 21. I'll tell you, I'm actually more impressed by the pending than anything else we're going to see because writing contracts over this holiday weekend, and I actually got one done that I was not expecting. And they sent their last counter over on July 4th. So I really wasn't expecting a lot of paperwork to be passed around, but to do 21 transactions in that window on a holiday weekend, while it's it's right above what we like to see on that ratio, I'm just impressed at all that anybody was trading paper. And look at the closings, 7. That's the one that we're not going to judge because listen, starting about Wednesday, and good for title companies and banks, but you know they were kind of put it in neutral. They tried to close up everything right before that. So we weren't expecting a lot of closed business running up around the 3rd. Most everybody had checked out and were moving on to what they were going to do. Price changes was even light. This is the one I expected to be a little bit more spiked going into the weekend, but at 43. So here's how I'm taking that data right now. I think everybody just kind of put it in neutral, and I can promise you that I already seeing what's going on this morning. We're going to have a super productive week this week. I guarantee you those price changes are going to be up. I'm getting a lot of showing calls. It's going to be a very active week at the beach. So let's get into it. Phillip Johns, thank you for being with us. Can you hear us loud and clear?
We got you, Casey. Glad to be here. Thank you for having me.
Man, it means a lot for you to come on. So, we were able to connect in the last 2 weeks, and you've been watching for some time, and you kind of came in and gave me a heads up that you're in the cost segregation world and been watching. So please, I'm going to tee you up that way. Will you tell us a little bit about more who you are, what you've been doing down here, and kind of what you're going to be bringing us today?
Absolutely. So I'm a licensed CPA in Alabama. I'm a W-2 employee. So I'm going to speak to, as when we get into it, I'm going to speak to a little bit of how I operate as well and why this cost segregation can work out so well for a W-2 employee. But I'm a CPA. We have been owning properties on 30A since 2020. I've been visiting the area since 2011. Just really love the area. We live about 3 hours away, so it's easy to get down there, up and back, even for just weekends. So we just really love 30A and the beach. We enjoy the mountains, but the beach is the only place that we found where we truly relax. So we love to be down there and just love to talk real estate and all things associated with that. So
awesome. Yeah. So you shared, I think you bought and sold. I think you bought one, sold one, bought another kind of since 2020. So you kind of came in right during the COVID time, right?
We did. Yeah, we closed actually on our first one January 3rd of 2020.
Oh,
And,
wow.
and
Yeah.
realized, in March, what have we done? Because we were
Yeah.
planning to rent it out and everything was shutting down. But thankfully, in Florida, it was only a few weeks to kind of figure out that we were going to open back up, and it really took off from there and worked out well, especially for those first few years when Florida was one of the few places you could go pretty unrestricted. So that worked out well as well.
Man, that's awesome. Yeah, you're right, man. When that your March was probably pretty. You might have sweat a little bit in
We
March.
did.
I did the same thing. I bought a lot that March, and it was because some people kind of flinched, and I knew that that's what they did. And I remember telling my wife, I'm like, this could go either way. But yeah, man, it came out aces. So good for you during that time. But if you do you think it helped at this point? You want me to pull up the deck and then we can kind of show everybody
Yeah.
kind of what we're looking at today.
Let's run through the deck, and then I'll kind of walk y'all through what we've done over the past few years. So ultimately, talking about you hear buzzwords, right? Cost segregation. What does it mean, and all that type of stuff. Here's ultimately what this can do. So this is a cash flow quadrant. If anybody's read Rich Dad, Poor Dad, this was kind of made famous in there. But essentially, the tax code is set up this way, where if you're an employee, that's under the E right there. You're essentially probably taxed the most in the code, unless you've got some other structures in place. And it kind of goes through this quadrant. But the best way to think about this is from the investor standpoint. The investor has the most tax advantages in the tax code. And so what cost segregation and material participation can do when on a vacation property is it can help move you from that E bracket as an employee, and it can help move you to the investor, where you're able to take advantage of higher deductions and everything else associated with that comes with running a short-term rental. The goal of this ultimately is that possibly you buy a place, you're able to run it like a short-term rental as an investor, and you're able to actually lower your tax bracket and lower the taxes that you owe on it because of how it's operating. And so on the next slide, we can kind of talk about a couple of examples of that, kind of what that looks like. All right. So let's just say you're a W-2 employee. Got two examples here. Maybe you make $500,000. You're purchasing a $2 million property. There's some generic rules and assumptions in place. And let me just do this caveat here. I am a CPA, but I'm not your CPA. So, don't hold these, to the absolute standard or whatever. But these are some general rules of thumb. Generally, the depreciable basis of the property is going to be about 80%. And what you're able to do with a cost segregation is you accelerate depreciation. And so that's going to accelerate that depreciation. That first example there has got $448,000 depreciation year or loss or whatever. And so essentially what you do is you wiped out your taxable income in that first year when you were able to do a cost segregation, and you're able to materially participate. And so what does that mean for somebody in a bracket that maybe you make $500,000 a year of W-2 income? You actually can get back over $150,000 of taxes, and you bought a beach place doing this. Mm-hmm. And so there are some other caveats to this. I mean, like, number one thing is and we're going to talk about this on the next slide, but you need to be able to work on your property. Like, you need to be the one doing the most work, and we'll talk about that on the material participation. But you're able to put your money to work in this situation. You're able to save taxes on it. And for us, you're also able to have a place that you are able to enjoy in a place that you love, like 30A, and you're building equity on that property and letting the rental income, help pay off the mortgage and all those things. Another example, just with maybe you don't make $500,000, maybe you make $300,000. You can kind of see how that example works there as well. Of course, it's not as much, but you're still getting back most of your taxable, if not all of your taxable income that you've paid in federally, and then also on a state basis if your state has taxable income.
Okay. So just to clear up one point as before we go forward, would this be not talking about the four quadrants? And I completely understand that. And you're right. I remember Rich Dad Poor Dad, and it made it simple for a lot of people, right?
Right.
With your examples, if I'm not a W-2 employee, do I have the option with this, or are you just giving an example of a W-2 employee?
No, you still have an option. Essentially, what this is doing is essentially technically real estate in the tax code is considered a passive activity.
Yeah.
And so what this is there's a tax, people call it a loophole. It's not really a loophole. It's written into the tax code. There is a carve out for if your average stay is 7 days or less, which is typical in a short-term rental. So that is something to, to kind of note, like if you're snowbirds, if you use snowbirds a lot, and they're renting for 60, 90 days in the off season, that could put you over the 7 days and you would not qualify. So
Gotcha.
Your average stay does need to be under 7 days. And what that does under that carve out, if it is, you move from a passive activity to an active activity. And that is what allows you to offset your W-2 income or possibly capital gains or business income. Maybe you're a business owner, and you have active business income that can offset using depreciation losses. That can put you on the active side, since the IRS considers if you're under 7 days, it's technically a business activity and not a rental activity.
Interesting. And don't let me jump ahead here, but you touched on it, so I'm just going to bring it up again.
Right.
Staying with the word active. And this was something that you educated me on in a side conversation. This isn't something where you're going to be able to, you can't take advantage of this by turning it over to a rental management company. You need to be the manager of the property. Is that correct?
It would be very hard to do if you're going to use somebody else to be your management company. I'm not going to say impossible, but it's going to be very hard to do, because what you have to show the IRS is you have to show that you're essentially doing more work in your property than anybody else. So we'll talk about what kind of work is in the property, but essentially you have to make sure that you're the one doing the most work possible in the property. And that includes tracking what other people are doing, such as your cleaners. I'm not saying you got to go clean the property. I mean, we live 3 hours away. We're not turning our properties at turns or whatever, but I am tracking. They spent 2 hours, 4 hours, whatever it is, on a spreadsheet, and also tracking my hours to show if the IRS ever came knocking, hey, this is why we took this. This is why we elected this active participation. Here's my hours. Here's my other, local responsible person. Here's their hours. Here's my cleaner's hours, all that type of stuff.
Gotcha. Okay. Yeah, that makes sense. Because I think don't you feel like that's a key word? That active word for me is like sticking. Like it's like that's the whole reason why you're allowed to even dive into this, correct?
That's what turns it into a business first.
Yeah.
Some passive activity where you just maybe put some money aside long term just to put, invest in some real estate and just, use the appreciation kind of off that. So,
which is interesting, because a lot of people, I get those calls, Philip, where they're like, okay, I've gotten money in the market. And a lot of people that put the money in the market, that is a bit, for the most part, passive. They just let either someone else handle it.
Right.
They don't want to day trade. They're not really looking to get on the ticker every day. And they may move it into this, but the mindset might need to shift a little bit, because this is just, but you find in your experience, the tax help is just way worth it. And probably to your point, in your experience, it's gotten a lot easier to do that these days with the tools that are out there. Is that what you found?
That's correct. I mean, we have there's several options. We use booking software that essentially you make one update, and in that main software, it pushes to Airbnb or VRBO, or you have a direct website, for all your bookings. You can set up your messages to go automatically. I mean, essentially, you only have to manually respond when a guest has a specific question or issue. And you have to be able to, sometimes you're going to get a message at 9 o'clock on a Saturday night that says the toilet's clogged or whatever it is,
Right. Right. That's part of it. So let me ask you this. And again, you keep me in line with where you want the questions to go. But what I'm looking at this, and you look at these numbers, especially how easy you've laid it out. I feel like anybody that's willing to take on the rental themselves, I mean, it's really just kind of getting with your CPA and going, because I've heard people come to me that have done it and they were like, they felt crazy not doing it with the tax burden that was coming down the line. And they had been thinking about for years looking at getting a rental property in our area. And this just kind of, the math just pushed it forward. Is that most of what the education brings forward to you? Or how would you say that, other than just like giving someone like yourself a call, like what's kind of that first step where they can kind of get the reality of what could be their options in something like this?
Yeah, I mean, absolutely. I'd be more than willing to kind of help, consult and walk somebody through this. I have a lot of contacts in the area through the years that we've been doing this. Essentially, that you can't, this does require a little investment in a cost segregation report, and I'm not the one doing it. I mean, this is a CPA, but they're also like an engineer focused kind of CPA. There's two options of them. There are reports that where somebody actually comes to your property in person, and those reports are probably going to start around $2,500 and probably go up to about $5,000 depending on the size of the property. And they're going to spend a day going through your property, documenting everything that they can can be pushed up from a standard. Typically in real estate, you say it's either a 27-year life or a 39 and a half, year life asset, and you're just taking $1 million and dividing by that or whatever, how much ever the price of the property is. What that cost segregation representative is doing is they're saying, you know what, that countertop is not going to last 39 years or whatever. We're going to push that forward into 5 or 7 year life. And then we're also with bonus depreciation, which is now currently in force in the tax code again at 100%. We're going to be able to write that asset off 100% right now because we were able to bring it to 5 to 7 year life, and now with 100%, we're able to push it forward all the way. So essentially, they're going through your property, looking for items that they can bring forward that are not, do not last for the 39 years. And typically, on those numbers you see on the screen, you kind of look at the percentages of what typically a price per property the items can be brought forward. And so that's kind of what they're doing. There's also a virtual option. So I've actually done one of these. I'm a CPA though, so I kind of know what they're looking for. But essentially, I FaceTimed a representative for about an hour. We walked through one of our properties, and they documented everything. I made sure to point out extra things that I know make a difference on the report on the ones that I've done before. And those are a little cheaper because you're not having to have the representative come out on site, but those probably are somewhere between the $1,500 to $3,000, depending on the size of the property.
Well, let's talk about the window of time, just because I don't want to go around that. Am I wrong in saying that was it January or late fall last year when this went to 100% again on that piece? Is that correct?
Last year, yeah.
Okay. Because that's when I really started hearing this conversation get moved forward again. And then I know you can't predict the future, but are we in a window of time where, what are your expectations for how long this could stay in at 100%? Or what do you kind of tell people if that question comes up?
Yeah, there's no crystal ball. I mean, of course, it matters, probably who's in the White House and what administration's kind of over that and what they kind of value. I would think you're probably in a pretty good window for at least the next 4 to 6 years. I mean, it would take some change, even if the next administration is completely different. It would take some time to get that redone for some lesser amount or a new tax bill to kind of be done. So, I mean, I would say for the next probably 4 to 6 years, you're probably in a pretty good window of taking advantage of this.
Okay. Here's that next slide.
Yeah,
just so we don't miss anything.
The material participation, we kind of hit on this a little bit. Just to go back slightly to the real estate kind of discussion of passive versus active, there's also in the tax code, there's a rule like to be a real estate professional, you're able to take these, move it from passive to active. But what that requires is generally you need to have a real estate license or some other real estate certification, and you have to work about 750 hours and prove that kind of on this thing. This does not require that because, and you can see on the screen kind of the different rules it has. And number 2 is kind of highlighted the biggest because it's kind of the easiest one that everybody can hit generally. And it's kind of like, you have to work at least 100 hours in the year on your property, and you also, no one else will do more than you. So like, it may be if your cleaner is going to work or somebody else is going to work 100 hours, you might need to be at 120 or whatever it is. And that's what that log is for that I mentioned. Gotcha. So that you can actually prove what you've done and how many hours. But here's the thing, working on your property is a lot of different things. Every time a guest sends you a message, right, that's considered work on your property. Right. Setting your prices and that's considered work on your property. When you go supervise a project at your property, that's considered work on your property. So if you've got a construction remodel going on and you need to be on site for a few days or however long, that can be considered work. And then of course, we kind of mentioned this. I mean, the way this works the best is if you're not afraid to get your hands a little dirty, on the weekends maybe. So, I mean, this is what we kind of do, especially during the off season, right? So, I mean, we're renting our places out, we want to make peak rental income, of course, but in the off season, I mean, we love the beach in October. I mean, October is 30 A's like prime time for us.
That's right.
So like go down there on the weekends in October. We'll, do a little painting, touch up some stuff, check up on some stuff and do that. And then, generally try to work at least 4 hours-ish, and then now it's time to head to the beach. And, the kids get to play on the beach and all that stuff. And we've kind of satisfied what we needed to do to write off some of the trip and kind of move along. So,
yeah. So, I mean, 2 hours a week, essentially for the year on your asset is not ridiculous to think about, but to your point, you just have to show you're the hardest working one on the staff, essentially. Which again, like you said, and that's what happens. Look, I joke with clients all the time. They come down to enjoy it. They're going to take on a project while they're here. So it's going to happen. But to your point, that could be a 5 or 6, 7 hour day doing that, and you're going to go above anybody. I mean, the cleaners are going to be an hour a week, or whatever it may be. So it's not hard to kind of process that piece of it. And so these boxes, it has to be just essentially one of these. Is that what you're saying?
That's correct. Just one. And the easiest one's number 2. I mean, number 3 would be, maybe you are local. And so you are going to turn the property, and that kind of stuff. And of course, that makes you an active participant, in this. But number 2 is the easiest one to reach if you're not probably local. And then also, you've got a W-2 job where, you can't just focus on this property all the time.
When this went to 100, remind me, when it went to 100%, remind me what it was for years before that. What did it fall into?
It was 100 during the last Trump administration, and then there was a stair stepper. So it had gone down to 80, and then it had gone down to 60.
Gotcha.
So it was stair stepping down to 40 and 20. That's how it was going to ride out. But right now, there's nothing in the code that has a stair step, in a certain amount of time.
And so it's back in place to reinvigorate or just kind of drive the whole real estate model, correct? I mean, that's the purpose of taking it back up to. And from what I can see, and you correct me if I'm wrong, I mean, it seems to be working. I mean, this is why I thank you for coming on. Like it's been in the background, and I think that a lot of people hear about it, but I think it's one of those things where it's just like putting it forward and actually speaking with somebody on it, and kind of, because I had several people try to do it at the end of last year, before the tax year closed out. Is that what you're going to see? You're going to see a lot of late fall kind of, because I mean, that's when everybody gets with their tax guy, right?
You do. You see a lot of 1031 money. And we haven't actually said that. So that's an important part of this. And, a 1031 allows you to take money from one investment and basically move it to another within a certain amount of time frame. and not have to pay taxes on it.
Yeah.
And so essentially, generally there are ways to work through this, but generally you want it to be like kind money. So like real estate to real estate and all that type of stuff. So you'll see more of that in the fall, where people really before the end of a tax year are trying to get a deal done. And if I can, that might be a good time to kind of pivot into our kind of what we just did. So we sold a property in Seacrest Beach, and it officially closed in November of 25. And so we sold that property. We knew it was going to sell, kind of been like, in negotiations, under contract since early October. And so we were already looking. And so we wanted to find something a little different. We kind of been eyeing for a little while, and we were able to roll that money. We 1031 from that transaction into our new transaction, and bought another place in December of 25. Generally, the rule is 6 months, so you need to move that money within 6 months. But Casey, to go back to your point a few slide or two ago, kind of asking like, does the making sure you get it in for the tax year help factor into a business decision? That really helped we were like, okay, we may not get our seller of our property that we closed in December was a little stubborn, maybe a little stuck on price that we thought was a little high.
Yeah.
But we said, if we can close in December though, it's going to make bigger tax advantages for us than waiting until sometime in 26, either finding something else or maybe even letting them get less stubborn off their price. Then we have to wait the whole year of 26 to work on this in 27. So we made the decision that we, in our opinion, probably overpaid slightly for our property, but from the tax advantage standpoint, it made sense because we were going to be able to get that. And we actually closed on the property December 30th, 2025. And here's an important rule. We were able to cost seg it. You do not have to cost seg it in that year. We cost segged it. We did the actual study in 2026, but you're able to do it for the 2025 year. But there's an important point. Your property has to be available for rent during that year. So we could not close and then just automatically take it. But me, and if somebody has questions, we can help make sure you're aware of this and walk through this with somebody. We had that property listed on Airbnb on December 30th. And we had that property available for rent. We had somebody, no one did rent it because it was last minute and, that kind of thing. But we had the property and we have the screenshots and the documentation to the IRS in case they ever came knocking. Property was technically available for rent and in service on December 31st, which allowed us to take our the cost segregation deduction from depreciation in 2025.
Yeah, so interesting because just closing on the 31st and that's just running it close. And we've often explained to people down here how wild it gets. The end of the year is like a big thing, and people come into that and they have these conversations, and probably to your disliking, a lot of people procrastinate on these conversations. And so they get rolling with it like mid-November. And look, I'm raising my hand. Like it's one of those things. But I had a situation this past December where I had a seller that didn't want to close until after the first of the year, but a buyer that wanted to close before the end of the year. And because he wasn't willing to close before the end of the year, what they were willing to pay for the property after a round of the year was significantly different. And we finally put that together, and he talked to his side, and it just goes to your point. Like that timing is super significant. And so you can, because on one hand you can be like, man, it's hard asset. Like that's funny that would change like that. But the tangible meaning to what it can be in taxes and like to your income, it just makes sense. You're just trading paper at that point for what it's going to be. And it's the end of the year. My Christmas time and New Year's, there's always a couple of those situations that come up, and we're just like game on for it. Like we know it's going to happen. But that part that you just mentioned, this year was the first time that I even heard that rule about you've got to show in that year that it's an active running business, so to speak.
That's correct.
You can get the advantages after that, but when the year of which you buy it, you've got to show that it's active.
That's correct. Yep.
Yeah, so interesting. So listen, let's do this with this. Like any time's a great time to kind of call you, but I mean everybody's pretty much, a lot of people have finished with their taxes for this year. Most people that are watching this are certainly engaged with it. I got a couple of people in town right now that are. Here's a couple of points I'm bringing out, and I'll let you correct me if I'm wrong. Number one, contact guys like you way sooner rather than later, in the tax year. Okay. Right. Number two, you need to be actively involved and ready to realistically have the mindset to take it on as you're the manager of the VRBO Airbnb situation yourself, which can seem a little bit daunting to people, but I think even you could help them with like, hey, here's how we do it. There's a lot of options out there. Yep. And then this doesn't, even though these examples are W-2, is there any different method to how you go about it with self-employed or anything like that? Or kind of does it change a lot if you're self-employed on that angle?
It doesn't change a lot. The results can still be the same. I mean, if you're making a good amount of money in your business and that type of thing, the W-2 aspect is that's one highlighted here because usually that this is not possible from that type on the tax code generally. Of being able to move something from a passive activity to an active activity. You can be a W-2 employee, invest in commercial real estate, and it's going to live on your passive side, and that's fine. But you're still going to pay, all the active tax, all the taxes on your W-2 that you have paid. Got it.
Okay. Man, this is great. I mean, it certainly helps clear up a lot, and I appreciate you. I feel like questions are going to come from this. You okay with us sharing your contact info?
Absolutely. Yeah.
Okay. And then I think what I'd like to do is we might revisit this maybe later in the fall, just to maybe as a reminder, to everybody kind of as we're rounding up that year. And then I think too, we see a lot of, right now is that instant gratification time. A lot of the things they're closing them because they're getting those bookings just immediately coming in. And then what I find from the market is then they start eyeballing those things that maybe they can enhance kind of going forward. Can I ask you this? Is there there's no advantage to, once you've done the depreciation, there's no advantage to, is there any additional, because I had this brought up one time, this is the reason I'm asking, is there any advantage in this situation to buying something that's been finished or something you have to add more money into the investment for remodel? I mean, from the tax standpoint, the asset's the asset, or does it matter if you have to invest more funds into it?
Well, it can matter, and this is exactly what we did. So we closed, as we talked about, into December, did the cost segregation. Well, all those assets that could be bonus depreciated were bonus depreciated. So guess what? Those assets were taken to zero. Well, our place also needed a remodel. Okay. So we were able to dispose those assets at the end of the, they'll be in my 26th year because we did the remodel starting in February. So we disposed those assets in February 2026, but they were at zero. So the remodel is going to put on new assets that are going to be also, not all of them, but up to, most of that can be 100% bonus depreciated in this 26th year. And so you're going to get that advantage as well. Of course, that's money that we spent and we put into the remodel, but we'll be able to write off almost 100% some of that, at the end of this tax year as well. So it can really almost double the benefit if you can. And what we did is some of that tax refund that we got from being able to have a huge paper loss on the 25 year, we were able to use that money to help fund the remodel as well. Man.
Yeah. I'm glad I asked that. I'd heard that kind of come up in conversation, but I think too, it's like, there's nothing you're going to buy down here that you don't want to, unless it's brand new, that you're not going to want to touch a little bit. There's going to be something in that. So that's nice to know that future investment can kind of be evaluated as well. Man, this is helpful, Phillip.
Good deal. Glad to talk about it.
think-
Love to talk about this stuff.
Well, listen, like I said, I think other conversations are going to come from this. I think that there's going to be additional questions. I think that what happens with conversations like this, other people come forward. I can't thank you enough. I know you said you've been watching the content for a little while. I'm glad you kind of came forward, and you've probably been waiting for me to get somebody with cost seg on, and you were like, you know what, Casey, I'll do it. Like you're kicking the can here. So, but I really appreciate you. It's a huge value add, and I love that you're active in it on 30A. It means a lot when you're talking about people rolling out of Seacrest and doing other things. So if it's okay, we're going to have you back and just kind of revisit that. And then in the meantime, I'll collect additional questions from people, and then I will certainly post your information and connect anyone that wants to reach out. And if I can help you get in touch with Phillip, we'll certainly do that.
Sounds good. I appreciate what you do, Casey. I just enjoy watching what's happening in the market down there. So appreciate you keeping us informed.
Yeah, man. Well, thank you. And we'll sign off with this. So hope everybody had a great 4th. Phillip, thank you so much. And going to be a big week. So we'll be back next week. And I promise you, by the way, the phone's ringing so far today, we'll have plenty to talk about. So yeah, everybody have a great week, and we will see you next week.